Real estate related troubles ahead. Mortgage companies are going bust and other real estate related companies may not be far behind. Home purchase mortgage applications are at a 20-year low, and since the 2008 housing market crash, there has been an increase in smaller lenders that don't have government emergency funding, and as the mortgage rates slow, these smaller lenders are caught in a cash crunch and it's simply wiping them out. All right, the U.S. mortgage industry is already seeing its first lenders go bust, as rates have increased just a short time ago, causing borrowers to slow down on purchasing homes due to the lack of home affordability. And for many buyers, we're hearing that they still feel that homes are overvalued. And hold on, many experts believe that the wave of troubles coming could signify the biggest housing bubble burst in almost 15 years. According to a Bloomberg market article published on August 19th, market watchers nonetheless expect a string of bankruptcies broad enough to trigger a spike in layoffs in an industry that employs hundreds of thousands of workers. More of the business is now controlled by independent lenders, and with mortgage volumes plunging this year, many struggling to stay afloat. Now, this article also goes on to say, unlike banks, independent lenders often don't have the emergency programs that they can tap for financing when times get tough, nor do they have stable deposit funding. According to the Mortgage Bankers Association, home purchase mortgage applications continue to hover around a 20-year low. And recently, approximately 18% less mortgage applications on home purchase mortgages than the same week just 1 year ago. Now, what's the mortgage industry doing to respond to the lower number of applicants? Well, they can either do one of two things. They can simply ride it out and spend some of the cash that they've earned over the last several years. This would mean that they would need to trim some fat, maybe cut back some employees, or could they actually cut back the requirements for borrowers that wouldn't have qualified for a mortgage just a few months ago? According to this article that was published on August 19th on CoreLogic.com, rising interest rates and higher home prices erode homebuyer affordability as fewer buyers can afford higher home mortgage costs. And as a result, the diminishing demand from borrowers may lead to an expansion of mortgage credit availability and mortgage risk as more borrowers are considered who may not have otherwise qualified for a mortgage when demand was higher. Now, in order to be approved for a home mortgage, guys, there are three key factors that a lender must consider from an applicant. Number one is debt to income ratio. How much does an applicant owe on monthly bills and expenses versus the income that they bring in each month? Number two, loan to value ratio. Now, this is the amount that they're borrowing against the appraised value of the home that they would like to buy. And number three, their credit score, otherwise known as the FICO score. This provides a score based on the borrower's credit history and the likelihood that they will pay back the mortgage in a timely fashion. Now, according to CoreLogic, two of these factors have recently changed. Mortgage credit availability and risk expanded in Q1 of 2022 as interest rates increased, leading to a higher debt-to-income ratio and slightly lower FICO scores. This means that mortgage applicants can have higher monthly bills than what were allowed before and slightly lower credit scores than what we've seen earlier this year. Loan to value has remained unchanged, and that means that the home must still appraise for the purchase price in order to qualify for the loan. Now, does this sound like a riskier mortgage to you? Lenders making riskier loans has certainly proved unsuccessful in the past, and some are actually going out of business. In the Bloomberg article, First Guaranty Mortgage has filed for bankruptcy, saying it failed after it made loans earlier this year that dropped in value. It was holding on to those loans until it had enough to bundle into bonds and sell to investors, and it had been temporarily funding the loans on their own credit line. And once the rates started to rise, lending shrank across the entire industry. That meant the company could no longer find new loans to bundle or get financing to keep operating. First Guaranty employed 600 people before it filed for bankruptcy in June, and they made $10.6 billion in home mortgages in the last year. Days before filing court protection, they let go 471 workers because they couldn't get enough money to overcome the cash crunch. crunch. And according to this article I found on Housing Wire, Sprout Mortgage announced in July to over 300 workers on a conference call that it was shutting down its operations. The article went on to say, former employees said the conference call was held at 4:30 p.m., notifying employees it was shutting down immediately. No severance was offered, and everyone was quickly locked out of the systems. And several staffers told Housing Wire that Sprout's shutdown occurred one day before payday. And guess what? They did not receive their paychecks. And I believe that this is only the beginning woes that are coming from mortgage lenders and other real estate related service providers as we watch home sales and refinancing of existing mortgages slam on the brakes. And if you're listening and you're working in the real estate industry, get prepared. I believe that this may last for years to come. And it's often said that what goes up must come down. And I think that you would have to agree that over the last 2 years, this real estate boom has literally created hundreds of thousands of new jobs. It has also enticed existing companies to finance and expand into new brick and mortars in multi-site locations. Now, I'm certainly not trying to be a pessimist here, but as someone that has gone through a couple of these downturns in my 33-year career, I think it may be time to pay attention to the writing on the wall. All right, thank you for your time watching this video. If you liked it, you can smash that thumbs up. It'll let me know that you did. And don't forget, if you haven't already done so, subscribe, hit the alert bell. It'll let you know every time I upload real estate content like this. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.